travel isn't just about destinations, it's about the people you meet, the cultures you immerse yourself in, the stories you carry home. I'm Relebogile Mabocha, and on my travel feature, I take you on a journey beyond the guidebook. Each week, I connect with fellow travelers, insiders, and storytellers to bring you the heart of every place, whether it's a hidden gem right here in South Africa or a dream destination abroad. Join me as we travel through conversations, memories, and inspiration. Listen wherever you get your podcasts.
The Money Show.
Personal Finance with Warren Ingram.
And Warren, of course, is a certified financial planner at Galileo Capital. Warren, good evening. We're talking unit trusts tonight. When was it? Back in 19-something that they were first created?
1965, Stephen. They're even older than me, and I was a bit surprised actually when I was prepping for the show to see that they're 60 years old this year, and it's remarkable. They've for a long time felt like the new kids on the block, but now they're grandparents.
Okay, so I mean, they've been around for a while. You are going to have to start, as always, with me, with a definition. How would you define at the very beginning a unit trust?
So the thing about a unit trust is it's a group of us that almost definitely don't know each other. And what happens is we pool our money together. So we club together and we put our money in one very big, large pool. And with that pool, it gets administered by independent custodian. So it's not just, everyone puts it in Warren's bank account and we hope that he's going to do the bookkeeping. It goes into an independent custodian who says, okay, I'm going to keep record of each of you and how much each of you have put in. And then once that money is put together, it's then invested on behalf of all of the individual investors by a fund manager. And in the early days, that would be a fund manager who would say, I'm just going to buy shares on the Johannesburg Stock Exchange, as an example. Over time, what happened is that they started diversifying away from just shares on the stock exchange. They started buying bonds. They started buying cash, creating money market unit trusts. So over this last 60 years, they've actually created many hundreds of different kinds of unit trusts so that you can do everything from buy a generic money market account right up to a global fund that invests in shares. And then there is the original kind of one answer to all questions, which is the balanced unit trust. And most of us, if we invest in a retirement annuity, the likelihood is we own at least one, if not a few of those balanced unit trusts. The important thing always about a unit trust is no one owns the assets of a unit trust except the actual investors. So if I were to launch, the Money Show unit trust tomorrow, and let's say it didn't work out in a year's time, it wouldn't matter that the Money Show went bankrupt. Obviously that's never going to happen, Stephen. But let's just say it did. It wouldn't matter because the investors would still be safe. They would still have all the money. They would be the owners of the fund, and then they would get paid out the money in that fund. So the benefit of a unit trust is it's very well regulated, independently administered by a custodian, and then a fund manager who manages the money according to a particular mandate or a benchmark or an agreed kind of objective for the fund. So I think that's maybe the reason that they've been around for so long is we've never seen in South Africa's history a situation where a crook has managed to take over a unit trust and steal all the money out of a fund. We've seen, I think it going way back to the Fidentia days where someone tried to do that, but it wasn't possible. And so I think that's probably a key for investors. It's transparent and something that we know is at least safe from fraud, if not bad decisions, which will always be a risk with investing.
Okay, so that makes a lot of sense. There's a sort of pizza analogy to this, isn't there?
Yeah, so if if you want to kind of get to the point of having a bit more variety in your life, and you can't afford to buy a massive pizza, what you can do is ask your friends to kind of club in together, and then collectively you buy one very big pizza with a whole lot of different ingredients on it, and then you can take a slice. And if you say, look, I'm happy to pay for half of the pizza, then you get half of the number of slices. Whereas perhaps if it's the end of the month money and you haven't been that good with your budgeting, maybe you're going to take a tiny slice. But the benefit there is that you get an allocation of a whole lot of different ingredients, and you get to taste at least a very nice slice of pizza. But it doesn't mean that you're prohibited from eating it because you have no money to buy the big one. You can club in with your friends and at least get a share. And to me, I like that as an analogy for us in the when we're looking at unit trusts, is we can't afford, for example, to buy every single share on the JSE, plus every single share globally, plus a collection of bonds and property companies and cash, and put that together in a portfolio for ourselves. We just wouldn't have enough money. But if there are a bunch of us putting all of that money together, then we can do that, and we get a lot more optionality around our investments, a lot more spread, and it's something that a small investor can participate in a very nice big portfolio alongside a bigger investor, and maybe tens of thousands of investors between the small and the large, and a whole variety in between. So it gives us a lot of variety and a lot of choice, and doing it on our own terms, because the nice thing about a unit trust is you buy in when you want to, and you exit when you want to. You're not stuck in there for a period of time in a contract or some kind of a terrible marriage where you're locked in for life. You can always sell out of a unit trust. They trade every single day of the week.
And then the key players is quite a small number, which must be attractive too.
I think so. I think, understanding that it gets a bit technical, which we don't need to get into, but essentially you've got a fund manager, and typically their name will be on the box. So it will be XYZ fund managers, and it will be their equity fund or their balanced fund or their cautious fund. And what they have is the right to manage that money according to what they've promised you. So they're going to set the objectives of the fund, and those objectives are strictly controlled by regulators, who will say, if you're going to invest in a fund that's called a general equity fund, it means you have to buy shares only. You may not buy shares, bonds, property, and maybe half of the fund in cash. That's not called a general equity fund. So the fund manager gets an agreed mandate, and that fund manager then does their very best to buy the shares that they believe in, and particularly ones that they think will give you long-term growth, faster than the index. What is important there is that it's not the fund manager's asset. So if that fund is worth 10 billion rand, the only people that own the 10 billion rand are the investors. So that would be all of us as individuals that have bought into that fund. And then separate from the fund manager and separate from the investors will then be an administration company that will take responsibility for keeping all the records, or basically the bookkeeping of the fund, and making sure that they know who owns what and who's entitled to what, and also then a custodian who looks after the assets to make sure that if the fund manager goes bankrupt, that the assets are still preserved, and that between the custodian and the administration company, they know who needs to get paid back. So there's that separation of responsibilities and very clear separation of who owns the assets and who has the right to manage those assets and charge a fee. And the interesting thing about unit trust is that they really became popular a long time ago because they were so very transparent with the way that they charged and what they were buying on behalf of investors. And that wasn't the case when we go back to the 60s. Money was generally controlled by insurance companies. They would put the money in big, very, very big pools, and you would just know that you're an investor in a pool of money, but you'd have no idea really what was inside that pool. You would have no idea what was actually being charged and what was being bought and sold on a monthly or quarterly basis. You would just get these vague reports every 6 months or every year, and you would hope that they would be right. So that's the other point about these, is that the administration company provides that transparency.
It does seem to be a real leap above. You can see why they're so popular. All right, different types of unit trusts that are available. Let's start with equity funds.
So just, I mean, unfortunately, my industry is full of jargon. So equity basically means shares, and you get a range of unit trusts that exclusively invest in shares. So the kind of original one would be general equity, and what that means is that it can buy shares across any of the sectors on the Johannesburg Stock Exchange. So whether it's mining shares, industrial, technology, pharmaceuticals, etc. And so it's got a broad mandate, and typically you'll find those will have quite a bias to larger companies on the JSE, just because they are the ones that are most investable. And nowadays you also get a global equity fund. So it just means that you can access a fund that buys shares on stock exchanges around the world. Then it does get a bit more specific. So you can get a fund, for example, that only invests in financial services companies, or only invests in mining houses or industrial businesses, etc. And globally, there are many more industrial sectors around the world. So you can, for example, buy a company that only invests in tech shares, or only invests in biotech or pharmaceuticals, etc. So a bit more variety overseas. Then you get bond funds, and typically those are funds that own a selection of government bonds and corporate bonds, and then maybe a variety of things called inflation-linked bonds and short-term money market instruments. So the idea there is that you're getting exposure to a broad bond market without being locked into only one bond. Then I think one that's probably familiar to a lot of us would be a money market unit trust, which is really a place where you store cash to earn the greatest or the highest rate of interest that you can for a short period of time. And hopefully it's a parking vehicle for you to do something with that money. It's certainly not a place you should be storing your investment money for long periods of time. Then the Swiss Army knife of unit trusts is the balanced fund. So that's a fund that will give you an allocation to cash, bonds, property, shares. Typically, if it's a balanced fund, it's got a bigger exposure to shares, and 45% of balanced funds can be invested internationally. So it gives you a huge amount of exposure to all different kinds of assets in South Africa and all around the world. So it's probably the one, as I mentioned, that we would own in our retirement funds, most of us. Then lastly, you get more and more of these very narrow speciality funds where you can buy a fund that only invests in commercial property, or only invests in industrial buildings, or gold, for example. Very, very popular a few years ago was just a gold fund. And globally, especially, there are funds that will invest in according to values or religion. So you get Sharia funds, you get ethical funds that avoid tobacco and alcohol and those kinds of things, the sin stocks. So you do get very, very specialized unit trusts as well.
It's so interesting just to see how many different types there are. I mean, it really does suggest that there are very big differences in all of this.
Travel isn't just about destinations. It's about the people you meet, the cultures you immerse yourself in, the stories you carry home. I'm Relebogile Mabotja, and on my travel feature, I take you on a journey beyond the guidebook. Each week, I connect with fellow travelers, insiders, and storytellers to bring you the heart of every place, whether it's a hidden gem right here in South Africa or a dream destination abroad. Join me as we travel through conversations, memories, and inspiration. Listen wherever you get your podcasts.
So,
travel isn't just about destinations. It's about the people you meet, the cultures you immerse yourself in, the stories you carry home. I'm Relebogile Mabotja, and on my travel feature, I take you on a journey beyond the guidebook. Each week, I connect with fellow travelers, insiders, and storytellers to bring you the heart of every place, whether it's a hidden gem right here in South Africa or a dream destination abroad. Join me as we travel through conversations, memories, and inspiration. Listen wherever you get your podcasts.
Obviously, you've got different ways in which you could do it, but you've got unit trusts, you've got exchange-traded funds, ETFs, and you've got direct shares. How do you assess which is the best one, especially if unit trusts have been around for so long and, by and large, seem to have done pretty well?
They have, and I think they are very, very large in investors' lives all around the world, and definitely in South Africa. And I think that the question then is, when something's old and established, is it not ripe for disruption? And, are there not alternatives that might be, bigger, better, faster? And in the investment world, bigger, better, faster means can you access those, those underlying investments inside a unit trust more cheaply, more efficiently, maybe even more transparently, and can you do that, without being constrained to only buying and selling once a day? And that's really what exchange traded funds are. Is they'll give you very similar optionality to a unit trust. So you can find an exchange traded fund that only buys South African shares, or only buys global shares, or only owns gold, etc. The difference now is that you can buy that on a stockbroking account or an investment platform. And very often you can do that on your phone, and you can trade those exchange traded funds 5 or 15 times per day if you really wanted to. I wouldn't recommend it. It'll cost you a fortune in transaction costs, but they're a lot more tradable and give you potentially a cost saving. I think one of the things that happened with unit trusts is because they were so big and so dominant, they weren't that efficient on fees. So they were a bit sluggish and on reducing costs for investors, and were very profitable for the asset managers. And so one of the things that happened with the advent of the exchange traded fund market was it forced the unit trust managers to wake up to the reality that they were overcharging and they needed to become a lot more efficient. So in the early days of exchange traded funds, you could find a fund that would cost you 0.5%, and a unit trust doing the same job might have cost you 1.5%. So there was a real threat to unit trusts, and exchange traded funds grew very quickly as a result. I think that the unit trust market has woken up to that, though, and nowadays you find that they are quite competitive on price. So the cost differential is not so big anymore. But the tradability is the advantage that exchange traded funds have. They trade in exactly the same way on the stock exchange as if you were buying a share. So I think that is an advantage. And potentially on the more modern platforms, they're a bit cheaper to buy an exchange traded fund for small amounts. For example, you could buy an exchange traded fund with 50 Rand or 100 Rand on some platforms, whereas most unit trusts, they'll want a minimum of at least 500 Rand as a debit order, and maybe 1,000 or even 10,000 Rand as a lump sum. So I do think that they've had a bit of competition. They have lost some market share, but I think that they're adapting, as the industry would, Stephen.
Yes, no, of course. And then with direct shares, you just buy what you want. I mean, that's simple, and you know exactly where you are.
Yeah, and if you are someone who has very high conviction that you believe what the next big thing is going to be, and it's a company that's listed, whether it's in South Africa or overseas, and if you believe that you've got an idea of what will be the next Apple, what will be the next Meta, and you wouldn't want to necessarily buy that as part of a pool of money, whether it's in an exchange traded fund or a unit trust. So the option there with the direct shares, you can allocate more money to a single investment, and if your research or whatever it is that's caused you to kind of come up with a view, if that works out, you could make a lot of money. And history is full of those kinds of examples of people that a very long time ago bought Naspers when it was 100 Rand a share, and it got to 3,000 or 4,000 Rand a share, and those people have made a lot of money. And the same with Apple, etc. So there is the advantage of being very specific with direct shares. The tradability is the same as an exchange traded fund, and the transparency is there. I would say, and I have to, I'm just, the risk manager inside me says, you've got to tell people that, your share could go from 100 Rand to zero. We've seen companies blow up. And so that's the one big downside of a direct share, is you've got all your eggs in that one basket. And, if it does well, that's great. If it goes to zero, you have nothing. And that has happened quite a lot in our country and all around the world.
A question for you coming in from Johan. Warren, hi, I need to draw a large amount of money from my investments for a deposit on a house. Is there a good way to do this? We'll have an answer for you in just a moment.
The Money Show.
Personal Finance with Warren Ingram.
And we had a question for you, Warren, from Johan, saying I need to draw a large amount of money from my investments for a deposit on a house. Is there a good way to do this? I mean, look, I know, Warren, you're going to say you never really want to withdraw money from your investments, but to do it for a house, probably the best possible reason.
I guess you're right, Stephen. I would prefer that you keep your money invested and live off a bit of the income to pay rent on a house. But if you are going to buy a house and it is a chunky amount of money that you've got to take out of your investments, I think two things that would come to mind. One will be the tax implications of selling money, selling an investment, because if it's grown well, there is a big chance that you're going to pay capital gains tax. So depending on how much time you've got to make that decision to sell the investment, you might want to do it over 1 year or preferably 2 tax years, because we're allowed to make 40,000 rands worth of profit on an investment before we pay tax. So if you can do it, let's say in January 1 tax year, and then you do half of what's required then, and you do the other half in March of the following tax year, that means you get 80,000 rands worth of profit before you pay tax, and that could save you a bit of capital gains tax. The other thing is, markets are so incredibly volatile now. They're moving in such big roller coasters that I'm not sure that I would want to sell all of my investments at one moment in time, and so I would really think about selling a portion. If you've got a bit of time on your side, let's say you've got 6 months before you need the money, then what you could do is sell a third now, wait 2 months, sell another third, and then wait 2 months and sell the last third. And the hope there is that if markets go up between now and then you're participating in some of that growth and you're locking in kind of higher prices over time. However, if markets fall apart between now and then the hope is that you've at least locked in 1/3 or 2/3 of the money at higher prices, and the last third might be a little bit exposed to a loss. But phasing money out of an investment is, I think, as sensible as phasing money into investments, especially when you're dealing in large lump sums. So just be aware of transaction costs. That's maybe my last comment. And then, if you can be tax efficient, do that. But be careful of trying to make very big calls and timing your decisions. You can't get it right when we've got people like Trump in this world.
Yeah, no, I mean, that really is the problem now. I mean, there was this astonishing comment from the research arm, the investment research arm of BlackRock today, saying that they're focusing on 6 to 12 month horizons at the moment because the anchors of the global economy have sort of disappeared. I mean, I thought that was a direct comment about the Trump administration from a real mover in the capitalist world. That's kind of the problem that we're facing.
We are, and when you see the chairman of the Reserve Bank of America saying, we would have cut interest rates if it wasn't for tariffs and the noise around tariffs. The tariffs haven't really taken effect properly, but what's happened is the threat is hanging over the world, and so just the threat of something, which could be implemented or might not be implemented at all, is really disrupting things. And then there is this move from the west to the east in terms of economic power. I think always the one advantage we've got as private investors is we don't have to move with other people's time horizons. So we can make investment decisions that are good for us over a 5 or 10 year period. And what I can tell you is whatever happens in the next 6 or 12 months, it's very unlikely to persist over 5 to 10 years. So if you stretch out your time horizon, you can kind of make yourself a little bit immune to all the noise and all the volatility. Markets tend to go up and do very well over longer periods of time. So that would be my secret in this whole thing.
Very quickly then, between ETFs and unit trusts and shares. ETFs, unit trusts, I mean, shares you're not a big fan of because you can lose all your money quite easily.
Yeah, I think that the unit trusts still are going to be the vehicle for most of us. They do very well for debit order investing, especially, and when you want lots of diversification. But if you are trading small amounts of money, it might be better to do that with exchange traded funds. But don't be scared of unit trusts because they're just because they're old, they're actually still pretty good.
Thanks very much indeed. Warren Ingram, of course, certified financial planner at Galileo Capital and with personal finance on The Money Show this evening.
Travel isn't just about destinations. It's about the people you meet, the cultures you immerse yourself in, the stories you carry home. I'm Relebogile Mabotja, and on my travel feature, I take you on a journey beyond the guidebook. Each week, I connect with fellow travelers, insiders, and storytellers to bring you the heart of every place. Whether it's a hidden gem right here in South Africa or a dream destination abroad. Join me as we travel through conversations, memories, and inspiration. Listen wherever you get your podcasts.